I just want to know, in this particular moment, given where you may think the market is, given where bond prices are, I think a lot of people are really trying to rethink what's the mix of what a portfolio is even supposed to look like in this world, given what's happening in Israel, in Ukraine and the like. Are you buying stuff? What are you doing?
Every day. I am amazingly bullish. And so basically in 1960s, there was Vietnam War, there was inflation, there were assassinations of the presidents of the United States, there was assassination of Robert Kennedy, assassination of Martin Luther King. I was a patent office examiner in Arlington, Virginia, and I went to law school at night and worked in patent office at daytime. And one day, right after King is assassinated, one of my friends, I'm on one side of the office, runs over and said, "Ronnie, come over here." And I ran to the other side of the building. All of Washington was on fire. Amazing. So we got on motorcycles and drove in. You're not allowed to. We broke into the city, driving around and came back. But that was the city falling apart. It looked like the country was ending. There would be marches on Washington. And the market, the Dow Jones was 1,000. The GDP was 800. 800 billion. That's now 27 trillion. The Dow Jones was 1,000 then. It's 34,000 now. It's 5 doubles. 5 doubles in the last 50 years, 53 years. That means you double every 5 years, every 10 years rather. So that means that's when we're around 7, right? So basically, the way I think about it is that inflation, whenever you have a war, you have a pandemic, you have to have inflation, the government has to pay for it. And when the government pays for it, then when you come out of it, they have to pay it back. The way they pay it back is not by paying down any debt, they pay it back by making your money worth less. So there's inflation. So the way we think about things is that inflation is going to reduce the value of your money in half about every 14 or 15 years. About 4 or 5% a year is inflation. That's my whole lifetime. 4 or 5%. Sometimes it's 2, sometimes it's 7, but 4 or 5% is the number.
So you would never buy a 2-year bond or a 5-year bond or
Ever.
a 10-year bond?
I've never owned a bond.
The Tesla-loving billionaire and CEO of Barron Capital, Ron Barron, brings an electrifying presence to an exciting CNBC Squawk Box interview. Barron's insights go beyond Tesla. He vividly depicts the rapid growth potential of the entire electric vehicle, EV market. Early investors in Tesla have already seen profitable returns, but Barron is convinced the best is yet to come. He positions himself at the helm of this exhilarating EV industry voyage, set to generate a new class of millionaires. The twist is that Barron's optimism isn't limited to Tesla. He exudes a contagious enthusiasm, inspired by the vast potential for growth across the entire electric vehicle market. In this stimulating video, we delve into Barron's top Tesla pick and reveal another EV stock poised to capture a significant portion of the burgeoning EV market. The EV revolution is just warming up, with electric vehicles still in the initial phase of worldwide adoption. The potential for growth is massive, especially among top EV companies. Barron encourages investors to shift their focus forward and zero in on EV stocks that could yield significant returns by 2030. In this high-energy race, EV sales are expected to reach 14 million cars in 2023, accounting for a solid 18% of total car sales. Looking ahead to 2030, prepare for a staggering change. EVs are expected to dominate, capturing over 60% of the total car sales market. This major shift heralds not just an increase in sales, but also substantial profits for pioneering EV manufacturers. Despite intensifying competition, the industry is likely to consolidate in the future, creating a special investment opportunity. Join us as we explore the compelling reasons to be optimistic about EVs, examining the journey to capitalize on this trend and the possibility of becoming a millionaire with smart EV stock investments. Now, let's explore Barron's preferred Tesla, followed by another promising EV contender.
They really were trying to define the company as an EV automobile maker. Is that the way you think about this company?
I think about it as a technology company that's providing services to their own company and to others. They can't possibly be matched by anyone else. They have data, technology. They make cars cheaper than anyone else. When Ford makes one of these cars, an electric car, every car they make, they lose $36,000 on. $36,000 per car. Our company now makes about $8,000 or $9,000 in profit a car. They were making $15,000 in profit a car. But if they build a plant that costs $7 billion for 1 million cars, that plant was making $15 million a year, $15 billion a year on a $7 billion investment. $15 billion on a $7 billion investment. An ordinary industrial company would make 15% on capital, 20% the most. This guy's making his capital twice a year. Now he's making it once a year. He's making $8 billion in a $7 million plan. So he's the lowest cost person. Everything about the business is trying to drive prices lower. Right now, they will be in a very, in the 1900s, early 1900s, the automobile companies were tremendous innovators. No longer is the case. In the 1950s, they decided they were going to go for profitability, and they outsourced all of their supply chain to their detriment. And all these companies went bankrupt. Hundreds of them went bankrupt. And now the way we're going is that their electric cars, they drive, I guess they have about 30 miles a day, 30 or 40 miles a day, and they have 3 million of them that are collecting data. 100 million miles a day they're getting for data, and then they're also getting compute that they're going to have more compute than anyone in the world in 18 months.
To begin, Barron underscored Tesla's unmatched efficiency, highlighting how its advanced data and technology provide a competitive edge in cost effectiveness. In contrast to other car manufacturers, Tesla is producing cars more economically, attracting attention in the process. Barron made a striking revelation. While traditional automakers like Ford lose $336,000 per car, Tesla earns a profit of $8,000 to $9,000 per vehicle. Quite the financial turnaround. But there's more. Barron views Tesla's data prowess as a pivotal change. With an impressive 100 million miles logged daily, Tesla's tech is on track to surpass its rivals. The Tesla fleet is effectively a mobile lab, consistently evolving and strengthening its position. And regarding the recent dip in electric vehicle demand, Barron maintains an optimistic perspective, attributing the decline to factors such as quality, pricing, and dealership issues. He believes the current electric cars lack appeal and are overpriced. However, he's confident that Tesla's forthcoming Model 2 will disrupt the market, making EVs more accessible with a price reduction from $40,000 to $225,000. And then there's China. Barron's excitement is limitless. He views China not only as a profitable market, but also as a key strategic partner. China has invited Elon Musk to enhance its car manufacturing sector, creating a mutually advantageous relationship. With the impending launch of Tesla's Model 2, Barron anticipates a significant sales boost, potentially reaching an astounding 5 million units annually. Ron Barron's enthusiastic stance on Tesla is genuinely stimulating, encompassing remarkable cost efficiency, technological leadership, and a strategic alliance with China. Tesla appears set for a thrilling path to success. Investors, buckle up. The Tesla story is just beginning. The recent market reaction to Tesla's Q3 figures presents a golden opportunity for long-term investors. Critics often misjudge Tesla as an overpriced car manufacturer, overlooking its essence as a tech innovator. Tesla's diverse business model is crucial in the global shift from fossil fuels to renewable energy, mirroring the success of tech giants like Apple and Sony Group. Although Q3 results might have disappointed some, Tesla is committed to achieving a 50% annual compound annual growth rate, CAGR, in vehicle production. The company's dedication to innovation drives its ongoing growth. In Tesla's revenue mix, energy storage is becoming a key component, with Q3 revenue up by 40% year-on-year, contributing to 6.6% of the company's total revenue. This growing importance aligns with Tesla's goal to equal its auto units revenue. In Asia, Tesla and BYD are leading the EV market charge. Both companies are outpacing the competition with strong growth patterns. BYD's Q3 triumph, marked by an 82% increase in net income year-on-year, highlights the success of its vertical integration strategy. Tesla, emulating BYD, is also enhancing its vertical integration, a move that provides greater supply chain control, crucial in industry-wide challenges like the price wars initiated by Tesla. The EV market's promise is further validated by projections showing EV sales will account for over 60% of total car sales by 2030, a significant jump from the expected 18% in 2023. This growth bodes well for leading EV manufacturers, offering substantial returns for investors. Now let's shift focus to the next EV standout, Rivian Automotive Incorporated, ticker symbol RIVN. Rivian, emerging as a star in the EV market, positions itself as an enticing investment with positive developments and strong performance in the third quarter of 2023. As an EV firm balancing production growth and financial viability, Rivian stands out from its rivals, appealing to long-term investors. Rivian's Q3 report, released on November 7th, not only exceeded earnings per share expectations, but also raised its 2023 production forecast. Unlike competitors such as Lucid Group, which lowered its production outlook and reported a yearly revenue drop, Rivian shows resilience and strategic execution in its EV approach. Rivian's 2023 production guidance increased by 2,000 units, leading to a total of 54,000 electric vehicles, which is a 4% rise. This update follows a pattern, as Rivian had previously upped its forecast by 2,000 units. The robust production growth in the first 3 quarters suggests Rivian might surpass 56,000 units. This positive trend is backed by the company's revenue report, with Q3 bringing in $1.34 billion, a 149% increase year-on-year. While Rivian isn't profitable yet, its financial indicators are improving. The company's gross margins are quickly getting better, with a minus 36% margin in Q3, a 135 percentage point enhancement from the previous year. This highlights Rivian's focus on financial stability amidst production expansion. In cash flow terms, Rivian is showing a promising direction. Despite a minus $1.1 billion free cash flow in the September quarter, it marked a 36% improvement from last year. This trajectory hints at the possibility of positive free cash flow by fiscal year 2026, indicating financial robustness. In valuation terms, Rivian seems undervalued compared to its large-cap US-based pure-play EV counterparts, with a price-to-revenue ratio of 2.41x. It's the most modestly valued among firms, with a market cap over $5 billion. The potential for revaluation is clear, with a projected 29% upside based on a reasonable 3.1x price-to-sales ratio. While Tesla leads in market cap and production volume, Rivian's impressive 121% production growth in the September quarter indicates it's breaking away from its competitors. This trend positions Rivian as an attractive investment choice, offering both growth potential and appealing valuation metrics. So, investors, there might be another fantastic opportunity waiting for you. Don't forget to subscribe to the channel for more insightful updates on investment.